Okay, let's go.
Have you ever wondered what's really going through a trader's head during one of those crazy high-pressure sessions? Well, today we're doing something really cool. We're going to break down the raw, unfiltered footage of a trader's final hour to really get a look at that razor-thin line between a calculated risk and, well, a flat-out gamble. And that brings us to the big question for this whole thing. We are about to watch a trader try to claw his way back from a loss. He's up against the clock, and he's doing it in the most chaotic 60 minutes of the entire trading day. This is a classic high-stakes challenge. Okay, so let's set the scene. Our trader is starting this final hour already in the red. He's down 5,000 rupees. The mission is pretty straightforward. Either recover that loss and end the day green, or risk digging himself into a much, much deeper hole. The pressure is on from the jump. So yeah, our story doesn't begin at zero. It starts with a deficit. From the get-go, this trader is already fighting an uphill battle, just trying to turn his day around. Now, you have to understand the environment here because it's absolutely crucial. We're in the last hour of an expiry day, a time that's just known for being completely insane. Options contracts are about to be worthless, their value is just evaporating by the second, and that creates these huge, unpredictable price swings. This isn't just trading, it's like trying to trade inside a hurricane. So how is he planning to navigate this total chaos? Well, he's actually got a specific game plan he calls adjustment theory. Let's break down what that really means. Right now, the market is what you'd call a strangle. Now, that's just a term for when the price is bouncing all over the place between two different points with no clear direction. Think of it like a pinball machine. The action is fast, it's chaotic, it's unpredictable. And for a trader looking for a clean, simple move, this is a really dangerous place to be. What he's looking for, his target, is what's called a straddle. This is when all that chaos disappears and the market kind of settles down and consolidates around one single price point. It's like the market is coiled up like a spring, just ready to make a big, decisive move in one direction. That's the moment he's waiting for. So the key here is that his plan isn't just to jump in and hope for the best. Nope, it's a waiting game. He has to have the discipline to sit on his hands and wait for that very specific market condition. That shift from the chaotic strangle to the calm straddle before he even thinks about pulling the trigger. All right, so let's get to the main event. Let's see how this whole theory plays out when there's immense pressure and, real money on the line. And boom, there it is. He sees the shift he's been waiting for. In a split second, he's in, buying 8,400 units. But look at the risk management. He immediately sets a teeny tiny stop loss of just 88 paisa. That's less than 1 rupee. Moments later, the price moves, he sells. The whole thing is over in seconds. And just look at the result. This one trade completely flips his day on its head. His P&L swings from a 5,000 rupee loss all the way to a 15,000 rupee profit. He didn't just recover his loss, he's now having a fantastic day. The strategy worked perfectly. But this is where the psychology totally changes. High on the win, he feels like he can't lose. It's that classic hot hand feeling, The idea that because you just won, you're obviously going to win again. So he decides to press his luck. And you can see him shift from that patient, calculated strategy to a much more aggressive one. So he jumps right back in, same huge position size. And to be fair, he is still being smart about his risk. He puts in another one of those super tight stop losses, making sure that if he's wrong, the damage is going to be small. And just like that, the market whips against him. You can hear that raw frustration in his voice as his stop loss gets hit almost instantly. He was forced out of the trade for a small loss. And you can see the immediate financial whiplash right here. That one small loss just sliced his day's profit nearly in half. In just a couple of seconds, he went from having a great day back to just one. And to add some serious salt to the wound, look what happened the second he was forced out. The price that stopped him out at 170, it immediately rocketed up to 400 rupees. His idea was completely right, but his timing was just a fraction of a second off. That is psychologically just brutal. He says it himself, almost double. He had to sit there and watch the exact move he predicted happen without him. I mean, that kind of near miss is incredibly painful, and it's the perfect trigger for the kind of emotional decisions he had managed to avoid. Until now. And that right there was the trigger. The whole session just descends into what traders call revenge trading. He starts firing off trades one after another, just desperate to get that win back. But the market's not cooperating. He gets hit by one small stop loss, then another, and another. And with each one of those tiny cuts, a piece of his profit, and maybe more importantly, his cool, just vanishes. You can just hear the change in his tone. All that confidence from before, it's gone. It's been replaced by this sense of defeat. He's not analyzing a strategy anymore. He's just fighting the market, and he knows he's losing. So as the final bell rings, his firefighting day, as he put it, finally comes to an end. After that absolute roller coaster of an hour, let's see what the final damage was.
And here it is, the final result. Not only did he not recover that initial 5,000 rupee loss, but all that frantic, emotional trading in the final minutes, it turned a small problem into a huge one. A 30,000 rupee loss for the day, all because of that desperate need to avoid ending the day in the red.
Which brings us all the way back to that core question we started with. What did we just witness here? Was this disciplined trading, or was it just impulsive gambling? Let's look at both sides of it. I mean, on the one hand, you could definitely argue it was trading. He started with a very specific strategy, he analyzed the market, and he consistently used stop losses to manage his risk. But on the other hand, you could easily call it gambling, right? The second that frustration hit, he started making these emotional, rapid-fire decisions, chasing his losses, and just fighting the market. All classic signs of a gambler on tilt. In the end, the trader himself is left wondering what to even call it. But maybe the line between trading and gambling isn't really about winning or losing. Maybe it's all about the process. That first trade, that was pure process. But after that one frustrating near miss, did emotion just take the wheel? Did the entire plan get thrown out the window? We saw the evidence, but the answer, well, it highlights a risk that